is there any point to trading a strategy that doesn't beat buy and hold?
I actually think this is a pretty good question. On one hand, I would say that your aim should be to actually beat buy and hold. On the other hand, it depends on your risk appetite and how much capital you've allocated to that strategy. If you look at the Sharpe ratio and the performance of the underlying asset that you're referring to, or the asset that you're trading, let's just say it's Qs, for example, or XLK, some kind of technology ETF. The max drawdown on that and the overall volatility can be pretty high. It could be, as much as like 35% or more. If that drawdown makes you pretty uncomfortable and your buy and hold, or excuse me, your strategy is built to trade trend within that range, and the overall absolute performance is less than the actual fund itself, you might ask yourself if your goals and objectives are to reduce drawdown and your strategy has, like, let's say a 10% max drawdown, well, then I think you've achieved your goals. So it just really kind of depends. Like, generally speaking, if your objectives are to beat the absolute returns, then yeah, you would want to try to focus on beating buy and hold as a benchmark objective. But if drawdown is actually something you're after, risk control is something you're after, then you may be comfortable not beating the buy and hold.
And many traders I know, at least, who use TradersPost and people who manually trade discretionary on a discretionary basis, their goal is to generate cash. Like it's
Sure.
their income.
Yeah.
They're full-time traders, so they need, like, they maybe could make more money if they were to just dump it into buy and hold, but they want to generate some income every month. So that's their goal. Like Mike said, depends on what your goals are.
Yep.
That's right. Actually, as you go on the hold, there's so many reasons to do it. Like, for example, the buy and hold has this. It's implying this risk freeness. There's a risk freeness of holding the asset, and that's not true. You are actually open to this risk, and if you're, and we're not talking about, like, let's say, just flash crashes. We're talking about recessionary periods. We're talking about contractionary periods where it could be 2, 3, 5, 10 years of down market, and then we're not talking about buy and hold. Also, the having a buy and hold portfolio and then having some discretionary amount to then trade, you can actually end up making more than just if you buy and hold, while still be able to take certain risks. Same thing with leverage, right? If you could be using leverage, well, you need to be able to trade, and you can actually end up making more than on buy and hold. So there's all kinds of reasons why you might want to do it. And for me, the idea for trading is that it teaches you so much, just so much, of how to think about risk, how to think about opportunity, how to capitalize on things. It opens you up to this potential of this gain that you would have in another way, and it teaches you about macroeconomics, about microeconomics. And so, to me, trading is more than just like poker, right? Where you leave the table and all you knew was more about the cards. It teaches you about life, about markets, about policy, about governments, about all these different things. So if it were up to me, trading would be a requirement in high school.
It's definitely made me a better long-term investor. There's been scenarios where I've used the skills that I picked up being an active trader to hedge my long-term positions or reduce at timely opportunities, and adding back in at the right opportunity. So yeah, it definitely helps you grow those skills.